Welcome to Beat the Markets.
I'm Ritger.
And I'm VKM. So Ritger, a couple of weeks ago, we decided to let's dive into Market Wizards and discuss it chapter by chapter. I thought the Michael Marcus video came out pretty good, so let's go to chapter 2 and discuss Bruce Kovner.
Let's do it.
So Bruce Kovner is one of the favorite chapters apparently amongst the traders, and I remember when I first read it, I don't even think I paid attention to the names. I just was, I guess, reading it more for the insight of what was written, but going back on it now and after, I don't know, 20, 30 years have elapsed, I guess, the names have gone on to be something. Bruce Kovner has gone on to become one of the great hedge fund managers, traders of our time. Started with like $2,000, $3,000 borrowed on a credit card, and I think something worth like $5 billion today. So we could say he beat the markets. So I guess we'll do it the same way. We'll alternate between the two of us, between what we each got out of the chapter.
Sure. Yeah. He started in I guess a little about him. He grew up in Brooklyn. When he was born in Brooklyn, moved to California as a young guy, went to Harvard undergrad, got interested in politics, went to the Kennedy School, and then actually taught a bit at Penn, I think in political science, worked on some political campaigns. I know in the later years he became somewhat of an influential neoconservative, became buddies with Dick Cheney and the whole crowd that was in the first Bush administration. But anyway, so he decided that politics weren't for him after working on some campaigns and started trading. It sounded like he just, at first he borrowed some money and opened an account with a little local futures brokerage. It was like a few $1,000s, $3,000. And the returns that these guys got in the 70s and early 80s were just staggering. I think this book came out when, 89? These interviews are what, 89 or so?
The book was published 89, so maybe did it over 87, 88?
Late 80s, yeah. So at that time, he was working with $650 million.
Which was a lot of money back then.
Hell of a lot of money. And just do the rate of...
But by the way, he's working with $600 million, and the year before was $300 million, so like he doubled his...
Yeah, he
had like 100%
Yeah, he
return.
said his profits in the prior year were $300 million. And these guys doubled their money year after year. He's asked what his worst year was. It was like down 16% in 1981. I mean, that's staggering. It's incredibly good. Obviously, the returns haven't been the same since. I think all these guys over 30 years have compounded, including all those years of doubling. Their compound rates of return have ended up being in the high teens. A few of them are maybe a little over 20. So I mean, the rates of return have really come down. Of course, interest rates have come down too, and when there's inflation and high interest rates, there's a built-in, there's a boost to your nominal number. But anyway, it's just staggering the returns they were able to extract from the markets. They were trading big in fast-moving markets.
So, to dovetail off of a few things you said, one of the things I find interesting in these guys that come out of different backgrounds. So, I guess in contemporary times, you hear people get attracted to the money of the hedge fund world or the trading, and they're driven at a young age, and they go to business school, and then they try to work at a hedge fund desk, and it's a little bit more of a track, I guess, for lack of a better word. When back then it seemed it was more of people stumbled into it different ways. They came out of all different kinds of backgrounds, and they kind of gravitated to the game of it somehow, and then they got involved, and they kind of liked it, and it wasn't so much of a... It was a different motive, I guess, of at least the initial interest in the game.
Mm-hmm. And a bunch of these guys ended up at Commodities Corporation.
Yeah, it seemed like the one of the probably, I came out of a day trading shop that's pretty well known amongst day traders. It sounded like Commodities Corporation was the equivalent of that in the 70s, where a lot of these guys knew each other and worked together.
And in the beginning, it was small. I mean, Commodities Corporation would stake them with 35 grand, and then they could trade whatever money of their own they had alongside that. So Kovner came in, he got his 35 grand, and by that time he had 40 grand of his own. And they would, what was it? Commodities Corporation would take like 20 or 30% a year of the account value of their money.
Yeah.
Just as like a fee.
No, there must have been a profit split.
There was a profit split, but it was like 30% like regardless.
Oh.
You had to make 30% before you made any money yourself.
Okay, I'm not sure of the deal.
It was. Don't hold me to 30%, but it was some huge return before they could even keep anything for themselves.
So in that realm, what was also interesting about Commodity Corporation being a center point where they all started was that Bruce Kovner said one of the things that was key was they also let them trade their own money.
Mm-hmm.
So that's something which through regulations probably is I know buddies that work at trading desks at banks and they can't trade their personal accounts the way they can, and there's some prevent conflict of interest and things. But if you're a real trader, I think you want to be able to trade your own account, and I thought that was an interesting.
Yeah, it's so key because trading is all about controlling your emotions, limiting your losses. And if those early mistakes are only made with other people's money, now when I lose other people's money, I feel worse than when I lose my own, but not everybody is that way, and there is something to losing your own money. And so, he mentions this in the book. He's asked, you have 650 million, of your own money, why are you still managing other people's money? He's like, it's a call option. It's it just makes sense.
Yeah, he said specifically he doesn't want to say that flippantly, and he cares a lot about what his investors think of him. But the fact of the matter is that it's a call option.
Sure. So you can keep.
That's
you could keep.
That's the classic win, not lose scenario.
Exactly. So if you bring a young guy in and he's only trading the house's money, he might not learn as fast. The mistakes he makes might not hit home or be felt as deeply.
And the other thing on this point is we feel tremendous onus of other people's money, but a lot of the other people's money we manage as an individual, we know them.
That's right.
For whatever reason, right or wrong, when it's an institution or when it's a corporation, I think there's a little bit less of you feel the gravitas of the burden a little less. I think. They're sophisticated investors. They know what they're doing. They're a little bit more aware of the ups and downs of things. Sometimes we feel the pain for the individual more than the individual even does because.
We're watching it every day. Certainly every month. The individuals, they don't always open their statements. Right. So they're lucky in that regard. They can just sit back and let the process do its thing.
Well, that's what they pay you for. I think part of it's to pay you to outsource the pain.
Yeah.
To get back on Bruce Kovner, the thing I thought the most important line of the book, most important line of the chapter, and most important line of the book, even though we're 2 chapters in only, and maybe there's going to be more important lines to come, but. To date, I think it's this one. He's talking about, so Michael Marcus, who we talked about in chapter 1, and Bruce Kovner were trading buddies. They traded together.
Yeah, Marcus hired Kovner.
And Marcus was, kind of his mentor. Mm-hmm. And he said, Michael Marcus taught me one thing that was incredibly important. He taught me you could make $1 million. He showed me that if you applied yourself, great things could happen. It is very easy to miss the point you really can do it. He showed me that if you take a position and use discipline, you can actually make it. I think that's such a key point, because I think in the contemporary times, between the idea of the random walk and the rise of passive investing, that people, I don't want to say this the wrong way because there's a lot of merit to that thinking, but it's a little bit of the acceptance of mediocrity. And this book was, for me, what this book did more than anything. Now, I was inclined to want to believe it, but what this book did, the same thing that was a Roger Bannister that ran the 4-minute mile, and then all of a sudden everybody could run under not everybody, but people that were on the bubble could run under 4 minutes. I don't know if it was Roger or Floyd. One was a pitcher and one was a runner.
Roger Bannister.
Bannister.
Now I am a middle distance runner actually, so I'll say that if you look closely at the data, you'll see that this happened, this kind of this drastic drop in times, in improvement in records in the 1950s happened in every event, not just the mile with its nice 4-minute round number.
Oh, interesting.
It was because the prior to that you had depression, you had wars, and this in the mid-late 50s you had the first guys who had gone through puberty after the war when there was plenty of meat, nobody was on rations.
Oh, interesting.
So I mean it's a cute story, and I think there is something to that effect. In trading, it's absolutely true. It's absolutely true. You need to believe that it is possible, that if you follow this process, that you will succeed. Just like in sports, you have to believe that.
You have to believe. You have, and I think Ed Seykota, and I have to think a little bit more about what he meant, but he says everybody gets what they want out of the market.
Exactly.
And I have to think about a little bit deeper into that. But there is this, if somebody shows you that it can be done, and somebody next to you is doing it, that's tremendously, important. And I think in today's, I don't know what everyone's saying, but I feel like the contemporary zeitgeist of investing is that don't even bother. You can't beat the markets. Just accept the mediocrity and
buy the index regardless of price, and that's all you need to know. Just be like everybody else.
So I thought, I think, people ask me. I ran into some buddies of mine this weekend, and they were talking about the video, and they said, why do you, they think it's fun, but why do you do it? And I said, one of the reasons I don't know how many people watch it. I have an idea. I don't think it's too many yet, but but I do it partly because I feel like we've accumulated a lot of knowledge in the space after a lot of years, and I'd like to get it down. So if my kids ever want to get in the space, which I doubt, but if they want to get into space, they have something to go to. And also, there's maybe one person out there or two persons out there that are interested in trading, and the way I learn from Market Wizards, maybe they'll learn something from us, and that would be of anything to be to learn is to motivate somebody to do it. And this is a big departure in the way I was thinking, because I got influenced by the I guess partly the zeitgeist at the time, and I think back on my own trading history, and I'm like, it's just amazing that I was, this is not to pump it's the opposite. I don't want to make it sound like I'm pumping myself up, but when I look back on my record, I think it's crazy that it worked out, and how many close I came to it not working out. And so when some young people come to me and say, well, what should I do to get in the business? My instinct is to want to say, well, don't. Because the odds of pulling it off are very, very, very difficult.
Like, we can give you a surefire path to a good, solid, long-term investing return. A surefire path.
Right, and that's much.
It's so easy to do. If you stick to it, start at an early age, just save your money, get it compounding. I mean, how could you give anything but that advice?
Right.
But there's a certain guy who's going to try. He's going to try anyway. And if he's going to try, well, there's a right way to go about it. There is a body of knowledge out there that will give you the greatest chance of succeeding.
Well put. That's exactly the comment. They both have merit. Mm-hmm. But there's going to be a certain guy, and I was one of those guys that you could tell me anything, but I was gonna take the. Yeah,
there are people who are going to try, and they're going to make the same mistakes. Everybody makes the same mistakes. They don't define their risk. They trade too big. They hold on to losing positions. There's all these things. I mean, you read going through this book. It actually gets repetitive because it's all about risk control in the end. They all talk about the same things. So we can go over how Kovner states what Marcus has stated and what John Tudor Jones is going to state, but it's all about risk control in the end.
Absolutely. So let's move on to one of the points you think that's worth discussing in the chapter.
Sure. I think he was eloquent in how he described position sizing, how he defined his risk. He would first find his stop. Now he had a hybrid process. It was not purely technical, and not purely. It was a combination of fundamentals and technicals, kind of like George Soros actually. So he would trade anything in the world. By the time of this interview, he had computer monitors set up in all of his homes and offices, and he had like an assistant who would wake him up in the middle of the night if necessary, and accounts at brokerages all around the world. So he could trade around the clock, and he was following the news, major macro events. Like he said, like call me. He had an instruction like if a prime minister resigns and I have a position there, wake me up in the middle of the night. So he would form these theses, hypotheses, and take positions, and then either cut them when proved wrong, or ride them, or add to them. But when establishing a position, he would look at a chart and find the level at which his thesis would be invalidated. Like if something had been trading in a range, and then he expected it to rally, or he was trading a breakout, he would then put a stop order at the bottom end of that range. Like it wouldn't be a big deal for something that was breaking out to the upside to fall back into that range because it had been there. But if it falls beneath that range, then that's like that invalidates that would invalidate the trade. Yeah, meaningful information. So he'd say, okay, that's the point at which I'm wrong. Now, how much money is that per contract? And if I'm going to lose no more than 1% of my account on this trade, that was his risk level, 1%, which is actually very aggressive relative to like a computerized trend following system, which would risk 15 basis points, 0.2%, something like that, 0.25%. So he would lose 1% of his account on the trade at a given number of contracts. So he'd do the math, and he'd say, it's 100 contracts of euro dollars, or it's 20 contracts of copper, whatever it was, and he would size his position to his stop. So it's kind of a low-tech way of doing what these computerized trend following programs would do by calculating the recent historical volatility and then sizing accordingly. So I thought that was it showed his discipline, because most guys would kind of have a more haphazard approach to the number of contracts they buy.
So I think this is one of the reasons why Kovner's chapter is really popular with traders. It gets into some of the intricacies of trading that only a trader could appreciate. And I put this a little bit later, but since you brought it up, I think this, the idea of how he, let me take a step back and talk about how his method of trading. He saw himself as this, I guess, the intellectual trader. That's how Soros thinks of himself. That where they had this map, this model of the world, and they try to figure it out, and they put themselves in the central banker's chair, and how he's going to have to respond to these situations, and therefore it can only be a certain number of things that he can do, and what would he be inclined to do, and then they would get ahead of it. And I think that's all interesting and fair and good, and makes a really attractive story. And I don't want to say they're disingenuous. I think they really believe they're doing that.
This is what I think most non-traders think, that this is what all traders do. Like if you're trading oil and copper and currencies and interest rates and all this, you must be reading the newspaper every day, and you must have buddies who know the the people who are on the board of central banks in Switzerland and Japan, and you're getting all this, you're in the flow of information, in the know, and keeping your pulse on the global economy and political situation. Now, a few guys do that.
I think a lot of people do that. I think traders themselves think they ought to do that. I have a friend who currently is a trader at a very big, he's one of the biggest asset managers in the world in foreign exchange, and this is what he, we started, we graduated college together, and he's like, I've been doing it a long time, I don't know how long I want to keep doing it. And I said, well, why I'm getting a little bit on a tangent, but he said, I wake up in the middle of the night four nights a year. It's very much like how Bruce Kovner talked about it. So I do think traders, even traders themselves, and I asked him how he trades, and he goes, same thing. I trade on a view. Like, I'm never going to just do something off of technicals or momentum or something. I have to have a view.
But what a lot of non-traders don't realize is that you don't have to do that.
I don't think they themselves don't have to do that. If you boil it down, that's what I wanted to get to.
Yeah,
if you boil down to what Kovner really was doing, what he's actually really doing is risk management and trend following.
Yes.
Right? Because what I loved was what he and I thought that was, I don't know if he did it intuitively but it's even though he had this sophisticated model of the world from that came out of his interest in politics, economics, from a trading perspective, it was also very sophisticated, which was that he would always have a bull case and a bear case, and this is what Soros talks about a little bit too. Also, like, the world's trying to feel its way out and figure out which way it wants to go, and he let the market decide.
The market would tell him which of these scenarios was playing out. Like he could make a case for why the dollar would rally. He talks about the week after the crash, the week of the crash in '87, after the crash. He thought that the dollar was going to rally because, just like it rallied in '08, actually, it's the safest asset in the world. If stocks are going down and interest rate spreads are going up, you're going to flee to the safety of the reserve currency. But the dollar didn't rally, and he was thinking about what he would do if he were a central banker. And he said that that West Germany's central bank was not printing, was not adding liquidity, was not easing, and the Japanese weren't easing. They were both hawks. So Baker at the time, the U.S. the chairman of the
he was the secretary.
He was the Treasury Secretary. Was going to have to ease, and so on Friday, the Friday of that week, he came to that conclusion. But the market had already closed, and he couldn't act on that theory. But he let the market. He was able to hold these contradictory hypotheses in his head, and then whichever way the market moved, he would just say, "Oh, that's what's happening in the real world."
Right, and I think that's a fantastic. If you need to believe and have a reason to have the conviction, I think that there's merit to that, and I think that's a very sophisticated. I don't know if he did in that, but a very good way to do about it.
There's something to it.
Have the scenario, if because otherwise you're going to get one-sided. You're always going to be one-sided on the market. You're always, because if you only have a bull case in your head for an asset, well then either you're going to get invalidated, or you're going to get validated. Then okay, you let them. But if you get invalidated, it's going to be very difficult to play the other way. You'll stop out and you'll just be like, okay, it doesn't make sense, and you'll look to try to re-engage, or just say, or have a rule that, look, if I get stopped out, I don't touch it for for at least 4 weeks or a quarter or whatever it may be. But I like this idea of, and it lends itself to currency trading. But I like this idea of having, and the fact of the matter is, in reality, there's always a bull case and a bear case. That's what makes a market.
Yeah. The other thing that it does is it allows you to believe in a position.
Yes,
something starts going one way, you take the position, then you can believe that it's going to continue.
Right, you're not so dismissive. You're not, the market is being irrational.
Yeah, you could say, there's another explanation. There's another dynamic at play. So that's the one that's at play. I can see how that's possible. Actually, this reminds me of another point he made. He said that he attributed some of his success to the ability to conceive of the world being vastly different than it is at present. Like he could see how something would go from $10 to $100 or vice versa. But this is a key point. People in the markets have such a short memory. I actually remember this. I'm going to toot my own horn here a little, because I remember like when we first started working together, it was 2014. And oil was just breaking down from its like $95 to $110 range. And I said, it can go to $35, no problem. And it did. It did within like 6 months. But that's the kind of thing that almost nobody is able to conceive. If oil's been $100 for like years, then it just seems like that's the price of oil. How could it possibly be any different? Peak oil, guys. But no, there can be a very different dynamic at play right now. And right now, when oil's been holding beneath $50, the story is, well, fracking, obviously. There's a lot more oil than we thought. Technology's keeping up. And that's like the accepted dogma, right?
Yeah.
As though it's like this obvious story.
Obviously. But
no, it's just prices. Prices doing their thing. It's psychology. Yeah, there are fundamentals at play too, but if the story follows the price, you can't really put any credence in the current story, because the story will change when the price changes, and you never know when the price is going to change, and you never know how far the price is going to change.
Sometimes that happens, in the same day. The asset will be down, and the news report will be stocks are down because Trump did that. Then they did it more with the. I don't think they give him any credit for anything. So but let's say president that they were a little bit more, I guess, generous with.
Yeah, this happens all the time. Like the news will be out at 8 a.m. The market will open up, and they'll say market opens up on news. Then like by 2 o'clock in the afternoon, the market is down. The news hasn't changed. Nothing has really happened between 8 and 2. And they'll say market down on same news. Same news,
or try to find something that fits the fact.
Yeah. Yeah. The reality is it's almost unpredictable. The degree that the market is predictable, on the short term, the market is only very slightly predictable. We're talking about like you get a slight edge, like blackjack edge, 51 to 49, that kind of thing. Maybe a little better, but it's not like making the call. Nobody has the ability to predict events, predict prices with any degree of accuracy. Your trades might be wrong 70% of the time, but it's about how you manage that risk.
Absolutely.
How much you make when you're right and how much you lose when you're wrong.
So just to put a fine point on what you talked about was that I think he said that one of the important jobs of a trader, and what he prided himself on, was the ability to imagine alternative scenarios.
Yeah.
And Rock, our buddy Rocket often talks about that as one of the key attributes of trading. And I didn't really appreciate it, I guess, as much as I guess when your own buddy says it versus Kovner. It's an important point that you have to have. Market. I guess the classic saying is. Markets can go higher than you can ever imagine and lower than you can ever imagine, and you have to your system or your methodology, your process has to be robust to
exactly
what's after the fact called Six Sigma events.
Yeah. Yeah, and the one that nobody's imagining right now is the stock market falling by 50%, which is done twice so far this century, and it's priced to do it again easily. S&P is 2,500. What is the Dow? 23,000. The Dow can easily go to 12,000, 10,000. That would be a rather normal valuation. And for the market to fall by 50, 60% would not be that unusual. It's the stock market. But here we are in 2017 with the markets having gone up and up and up and up year after year. It's hard for people to conceive of them doing anything but going up or falling back to those kinds of prices. It's inconceivable for the vast majority of people That's just not a reality that they can entertain. And they'll have all kinds of reasons why that can't happen. Interest rates are low, the Fed will print, the economy's strong, what have you. But and just like nobody would have conceived that the markets would get as high as they did. When the Dow was 10,000, when the Dow was 7,000 near the bottom. Nobody believed that within a few years we'd be looking at 20,000 plus. It's just inconceivable. But that's the kind of thing that happens all the time. Prices just continually surprise you by swinging from extreme to extreme. Staying up for longer than you can think they can stay up, staying down for longer than you can think they can stay down. Like, look at gold. Like, what a crazy thing for gold to go from $850. Oh, gold was $35 in 1971? Or was it had been, I think the peg had been moved to like 41 in 1971. Nixon, when Nixon completely severed the tie of the dollar to gold and broke the Bretton Woods system. 9 years later, it was $850, very briefly, but it touched $850, which is a huge amount of money. Inconceivable. And then, what does everybody believe about gold? When there's inflation, gold does well. Well, the dollar lost more than half its value between 1980 and the year 2000. What did gold do?
Also lost half its value. Lost more.
More than half its value, while the dollar lost half. So how does that make any sense? How could 20 years later the dollar be worth just $250? I mean, the gold be worth just $250 when the dollar was worth less? It didn't make any sense. But that's just what happens. It doesn't always make sense. In retrospect, you make up a story for it. You say, oh, it was disinflation, like we had high inflation in 1980, and inflation, steadily came down, but we still had inflation. The dollar was still losing value.
Yeah. Well, in hindsight, would say that 800 it was fully priced it in. But again, it's all obvious after. It's all obvious after the fact.
For Bitcoin, here's Bitcoin to $5,000. That's surprising to me. Like, it was a total mania a few months ago when it was $2,000. Here it is at $5,000. Crazy. I mean, it can go higher. It can fall back to 1,000. It can fall back to 500. Who knows?
And so, to that point that's where it's important to have a process. With Bitcoin or with anything, these moves are inconceivable to the I don't want to call it the rational mind, but in the contemporary setup. But so you want to have your system be able to account to capture those gains and manage the risk if it's wrong. So to your point of the stock market falls significantly. It could. It's one of I guess 3 scenarios, right? Markets can go up a lot, can go down a lot, or stay around here. And so it's one of 3 scenarios. Maybe the odds are are not a third. But you want to be able to have a system that can thrive in any scenario. Mm-hmm. So the other thing. I thought that was really an important point of the book. It goes back to what he was talking about is when he was working with Michael Marcus, and besides the idea that Marcus showed him that one can do it if they worked hard and actually make the $1 million. The other one he said was, he also taught me the other thing that is absolutely critical. You have to be willing to make mistakes regularly. I never turned on the sound. Did you?
Yeah, I did.
Oh. The other thing that's absolutely critical, you have to be willing to make mistakes regularly. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, and then doubling your money. So that's one of the things that as traders is sometimes, or often when you make a mistake, you kick yourself or you're hard on yourself. And I think that's an important point to remember, is that that's part of the business. You're not going to be right all the time, and you have to have a system that gives you the edge over time, and stay with the process, and you're going to be wrong.
Take your losses quickly and lightly. Don't feel bad about taking little losses. It's just, if you're taking a lot of little losses, you're doing it right. You're doing things right.
Right. I forget who said it, but learn to love to lose.
Learn to love to lose. Yeah, that was Paul Tudor Jones. Actually, he got it from some old trader in the cotton trading pit in New Orleans.
That's where Paul Tudor Jones started, right? Okay, so you have a few other interesting insights or things you want to talk about from this chapter?
Let's see.
You covered a lot. I'll tell you one that I thought that was interesting was we talked about the Heisenberg Principle, where the idea if something is closely observed, the odds are that it's going to be altered in the process, or the idea that a price pattern, the more it's observed by more speculators, the less, the more prone it's to be a false signal, and the less observed it is, the more it's a product of non-speculative activity, the greater the significance of the technical breakout.
Right. He also said that he liked a move that was unexpected by any of the gurus. Like you would have this, I guess you would read Marty Zweig, Robert Prechter, a few other guys who had, influential newsletters back in the 80s. And if they all had the same point of view and they all ended up being wrong, that was great. Like that was going to be a good trade. Yeah, an unexpected move, even one that he didn't expect, was to be preferred, was to be believed in. Whereas if everybody expected a breakout to go a certain way and that breakout happened, it was more likely to fail and retrace back to where it came from.
Right, and that's obvious if you're familiar with the world of sports betting, is that the more people believe in something, I guess it's priced in.
Right.
But I thought that was a great way of using the guru report, which is just have a lot of read all the gurus, and he didn't really use it to follow their advice, but to have an idea of where the consensus was at or what the thinking was.
Actually reminds me of there's these sentiment surveys. There's some that survey institutional investors, some that survey advisors, others that survey traders. And when sentiment gets really lopsided, either really bullish or really bearish on a certain market, and it stays that way for a while, that's the setup for a nice reversal. Once everybody believes the same thing, and the market starts to move. Like the biggest example I've seen of this was the bottom in 2009 for the stock market. We had like 95% of traders believing that the market was going to fall further when it was all the way back at 1996 levels. 95% thought that it was going to fall further because it had fallen for 18 months, and it was just kind of like a steady grinding decline through January, February, early March. And then when the market broke out to the upside, it started to climb that wall of worry. And why do they call it a wall of worry? It's because it starts from a position where everybody's bearish. So it breaks out to the upside, and a few guys, like that 5% bulls, they were right, and they hold on. And then it goes a little further, and a few more guys say, oh, it might be something to it, and they jump on. And like little by little, the sentiment, guys switch from bears to bulls. And it's that shift in sentiment, like guy by guy, and from strongly bearish to neutral to bullish to strongly bullish. It's that shift that drives the market higher and higher or lower and lower. And see, it's a great situation to have, where it's just fully primed to move one way or the other.
Agreed. I have a few other points here we could discuss if you think if you have something, or if you have something off the top of your.
No, what else? What else?
Well, which Jack Schwager always asks is in the realm of what's advice for a novice trader. And I think that's probably worth discussing. So, what we talked about, and like you said, it's going to become repetitive, but his advice for the novice trader is risk management is the most important thing to be well understood. The second thing is undertrade. Most people take a position size that's too big. And then the common view is to think the market as your personal nemesis. Like, why are you doing this to me? So, but one of the things in that I thought that was important is, all of them are important, but the idea of undertrading. And I think what happens with trading a lot, or people get into it, is you get interested in making the money, and when you really believe in something, you put on you put on a heavy trade, or you feel I'm so right on this one, I need to get paid I need to get paid. And I think the idea of undertrading is more about developing the process. He talks about this a little bit late. In another, it goes there's a lot of 1 year wonders in trading. Yeah. Things are lined up, and you can see something clearly, and you make your bet, and you turn out to be right, and you make a say a pot of money. But I think that's what the difference between learning the craft and learning the processes versus being.
If you overtrade, you don't have long enough to learn the craft, because sooner or later you're going to get a string of bad hands and you'll be wiped out.
So,
whereas if you're risking 1% or less per trade, that'll buy you a lot of time. You have to be very, very unlucky to get a greater than 50% drawdown with solid risk management.
And I think it probably is, frustrating in the beginning to think that, if you see the trade work out, to be like, oh, I should have bet more. But I think it requires a lot of discipline and belief in the long-term benefit of doing something like that.
There was somebody, I don't know if it was a Market Wizards interview or some other interview I read recently, where I think it was elsewhere. I forget who it was though. But this trader had said that the best thing that ever happened to him was selling his put option position, a massive put option position, just before the crash of '87. So if he'd held that position, he would have made a fortune in his 20s as a young man. But he got nervous, and the day before, he sold that position. He said, looking back on it, I'm grateful, because if that had gone my way, I would have thought that I was a genius, and I would have kept trading too big, and I probably wouldn't have made it. I probably would have blown up sooner or later.
That's insightful. It's an insightful thing. We spent some time in the resource industry, and that was one of the things I learned from one of the resources guys I was working with in the past. He said, the worst thing that happens in the mining business is to make a discovery very early in your life, because you kind of learn a lot of, or have success too early in life in general, because you end up learning a lot of probably things that aren't true, but the success that you had makes you feel that those things are valid.
Yeah. You got to be humble. That's what all these guys say.
So then Schwager, another common thing he's asked, what makes for a successful trader, and he talks about, and this is one, this goes with this is an age-old thing. That's what who's the two turtle guys? Richard Dennis and his business partner. I forget his name, but it had like an Irish last name, but it's slipping my mind. And that's what the movie Trading Places was about. Is it something that's learned, or is it something that's born? And that was the idea of getting Eddie Murphy and Dan Aykroyd, or to see if it's a learned skill. So everyone has their point of view, but from a broader context, this is where I'm at in my thinking is at presence. I think everything is a learned skill, and I think it's done through just jumping in the pool and having repeatedly doing it, and having some sort of feedback system that lets you improve upon it. And I think you can move mountains if you.
I agree. You have to have the aptitude. Not everybody has the aptitude, but it's not something you're born with. That's for sure. Reading all these interviews, none of these guys just naturally knew how to trade and succeeded from the start.
There's some things that, we talked about the last one, there's some of them that seem to get it a little quicker than others, and that always fascinates me. Like Kovner, the worst thing he did was, the worst tragedy he had was when he went from like $3,000 to $40,000 to $20,000.
Yeah, and he never went completely bust, unlike Michael Marcus, who went bust like several times.
Yeah, that was like his worst situation, and from that he gleaned a lot of knowledge and realized that didn't have risk management, and his emotions got the better of him. And he did it on the big scheme of things, not a lot of money, but gained a lot of insight from that.
Yeah, he was a quick study.
But yeah,
Kovner says it's not intelligence. Whatever the common denominator is among these people I've been able to teach to trade, it's not intelligence.
Right, he doesn't know quite what it is, but yeah, he said he's trained like 30 at this point, 30 or 35 people, and 3 or 4 have worked out. And
obviously, like Buffett says, to be him, to do what he's done, he said you probably need an IQ of 130. But that's a lot of people. That's like, I don't know, what is that, 3% of the population, something like that. And there's only one Buffett in the world. Well, there's Munger too, but there's not that many of them. So there's something else in addition to that. And to be a great trader, I don't know, the arithmetic's pretty simple. I don't think you even need 130 IQ. It's just a little above average, and just learn. You just have to learn your lessons and stick to them.
I think,
like military,
I don't think you need to have too much of an IQ. You just have to, and you have to believe that it can be done.
Yeah.
I'm good with Kovner for now. I sure hope it got recorded, whatever I had to say. Do you have anything that you'd like to touch upon?
I think that's it. I mean, these are great interviews. Looking forward to reading some more.
Thanks for watching.
See you next time.